What's going on out there? It's February 22nd. I'm Frank Curzio, it's the Wall Street Unplugged podcast where I break the headlines and tell you what's really moving these markets. So, Daniel Creech Wednesdays, I'm not going to be saying that anymore since, Daniel, I think you graduated, right? Next week, our podcast is going to be part of Wall Street Unplugged Premium. What do you think? Oh,
good. It's a promotion. I was hoping it wasn't this Don Lemon promotion from evenings to mornings in the morning.
Is he going to?
He already did.
I thought they kicked him off already for that, but
yeah. It'll always be Wednesday to me, fellas.
No, it's great stuff. So you're going to see this podcast where we break down stocks, details, going to have picks and everything for Wall Street Unplugged Premium. Guys, if you haven't subscribed yet, go to WSUoffer.com. It's just $10 a month. You can cancel anytime. Again, I'm going to have newsletters under that, which is Dollar Stock Club. Frankly speaking, lots of great content. Awesome content for you guys. Looking forward to launching that next week, March 1st, I think it is, or maybe March 2nd. Wednesday, Thursday. But Daniel, how's it going, man? How's everything?
I'm doing well. It's a beautiful day here on the island.
Well, beautiful day. But I have to tell you, it's pretty cold out there in other places of the United States. You see the snow that they're going to get, like in Minnesota and stuff like that? It's crazy.
No, I didn't.
I
know there's a winter storm going, but
yeah,
but it's winter for everybody else.
2 feet of snow. But I was in Minnesota for the Super Bowl. The Eagles 2017, the only time I think I've been in Minnesota. Holy cow. I mean, that's a level of cold. I think it was minus 15, 20 wind chill. I mean, that's a different level of cold. You don't, it goes through your bones and stuff.
I'm going to have fun with you. You're in an indoor stadium. You have tunnels in Minnesota. You were outside for what?
We didn't have tunnels.
I'm kidding. No.
Yeah, I wish we had
They
tunnels.
do have walkways, but just not for
They have walkways in certain places that you could hang out and party in before the Super Bowl.
But not where you needed to go.
Yeah, I mean, we were a block and a half away, which wasn't too bad, but still, we were outside for a good half an hour, 40 minutes, which is like 5 hours in that weather.
Yeah, exactly.
And it was
That's
pretty
funny.
crazy. So, but anyway, enough of that. Who cares? I'm complaining about going to the Super Bowl because it's too cold. All right, who's worse than me? Anyway, so let's get into what's going on with the markets today. The Fed minutes are out later today. They're not out yet as we're doing this podcast, but people talking about what the Fed president said, how they discussed this, and again, these minutes are just going to show what they're concerned about. But to me, it's going to be pretty meaningless because it's a much different environment from February 1st when this meeting took place compared to now, where we saw horrible numbers from retail sales, the Consumer Price Index, the PPI, right? 3 in a row that we saw that inflation wasn't moderating. We saw strong results, and that hinted that the Fed's definitely going to raise much more, where we saw the terminal rate, I think, Daniel, go from, which is the peak rate, go from 4.8 to now 5.3, 5.2, 5.3, which is massive. We talk about 3 weeks' time. A lot's different. A lot has changed. So I don't know what we're going to know from the minutes, because if you took it from 3 weeks ago, it looked like everything was great. The markets are on fire. Hey, we're going to avoid recession. Everything's fine. And now all of a sudden, out of nowhere, 3 straight reports over the last 3 weeks. I don't know what the minutes are going to tell, but that's what they're talking about, in the major networks and CNBC. I don't know if that's going to be that big of a deal, because I think that the tone's going to be much different today than it was 3 weeks ago, which is pretty crazy. We're talking about economic data, right? We're talking about stuff that should take months to filter in, years to filter in, and 3 weeks is not is to see the change that we've seen, Dan, where the 10-year was 3.4%. It's now over 3.9%. The 30-year fixed mortgage rate was just below 5%. It's 6.7%. Again, this is from February 1st till now. The 6-month T-bills over 5%. Quick question: do you know where the 6-month T-bill? Do you know where it was a year ago today? If you had a guess, so it's at over 5% now.
Oh, I don't know, but a guess, I'd say 100%. So it's up over 100. So I'd say 2.5.
0.6%.
Yeah, that's good.
Isn't that insane? Like, I was surprised. I mean, it makes sense when you think about it, because rates were very, very low.
Well, that's true. Yeah.
The Fed right before they began to raise rates, but I just couldn't believe. But it's much different. But I don't know if this is going to be meaningless or not. Let's see what they say, because the market is going to react the way it's going to react, and we'll see it come out later on. If we're up or down like a huge percentage, you'll see it. A lot might have to do with the minutes, but I'm not too sure if that's a big story considering how much has changed, right? Well,
I think it needs to be meaningless from the standpoint of, to your point, a lot of things have changed. It's not like they changed these minutes. I'll be honest, I guess I'm not above the pay grade to understand why you don't release these minutes closer to this meeting or whatever.
That does make sense.
But
wait
my point is that
3 weeks later,
the language better not be any different than his press conference and the recent speaking he did and all that kind of thing. Other that's going to throw a lot of uncertainty, and uncertainty is terrible.
And he had that credibility problem, right? Where it was just, he would come on TV and the market would take off, and then the next day he would come out and be like, no, I didn't want you to think that we were, we're going to stop anytime soon. And the back and forth between, what he said at the meetings compared to, what he said a couple of days later was different, right? So you make a good point.
Yeah, and so it should be much to do about nothing. We'll see. I would pay attention to this. I will pay attention to it. But to your point, I'm not going to put a whole lot of weight into it because we have some more readings. Because between last meeting and the next meeting in March, I think there's a 7-week gap, if memory serves me correct. So we still have more inflation data coming out before the next meeting, which they're already floating the 50 basis point raise coming up and all that. They're trying to price that into the market. Or maybe they're not. I shouldn't say that, but it seems to be pricing in. Yes, hopefully it's worthless, and then we can move on and get to more data, as it comes.
And you're right. I don't know why. It's like a transcript of the meeting. Why wouldn't they release it earlier, right? Why did they wait 3 weeks later? Because you see the big difference now. Just to tell you how big the difference is, at the end of that meeting, there was no discussions of a potential 50-point basis hike, right?
Right.
There was nothing on the table, right? I mean, if I had to guess, it was close to zero that was going to happen. A lot of people thought we were done. Stanley was saying, that's it. That's the last rate hike or whatever. Now, 3 weeks later, there's a 25% chance based on the Fed Fund future market that we could see a 50 basis point hike. That's a huge difference in 3 weeks, right? I keep saying that, but it really is. You have to understand, we're not in healthy markets where you see stuff like this, especially rates change this drastically, where we're used to pricing, 25 basis point hikes and cuts are the norm for the past 20 years, right? 20 years even plus. Where it's not often you're going to see more than that or less than that, right? Most of them are. And to say in 3 weeks, we're now pricing in, from the terminal rate of 4.8%, which was 3 weeks ago, to now 5.2, 5.3. That's a 50 basis point hike that the bond market is telling you that needs to come. That wasn't pricing just 3 weeks ago. So that it is significant. It really is.
Not to spend too much time on Powell here, because I know we got some fun stuff. Do you think they would come out with a 50 basis point hike at the next meeting, or do you think they would come out with a 25 and then hint at another hike in the future and then leave the door open for 50? Does that? I don't know if I did a good job explaining that. I think it's going to
depend on the data. I mean, if we see that CPI is, because we are seeing it in some areas, right? In some areas, the job market remains strong. Although we'll get to ZipRecruiter, which reported today, which is a disaster. I feel like nobody's really talking about that, and that's a very, very big story for the positive. Right. And for me, it'll go against my thesis of saying, hey, it's going to get a lot worse. I think people aren't pricing in. But when you see that, I'll talk about ZipRecruiter in a second. But it is going to depend on the data because we're not seeing inflation. We saw inflation was coming down.
Hold on. Even if data's bad between now and the next meeting, do you think they would come out and hike 50?
Oh, I think they might have to.
Oh, nice.
I think they might have to, yeah.
See, I don't think so. I think they'd come out with 25 and then hint, because if he comes out of the guns, unless they leak it to their favorite Wall Street Journal guy, that would be that'd be wild.
It does like right now, I would say one rate hike was potentially on the table, and that was in at the beginning, at the last meeting 3 weeks ago. Now it's at least two. But if we get data showing that retail sales are surging, we're seeing prices not coming down and going back up again. It's this push and pull with the markets where you're like, okay, we're not going to recession, but you need to force a recession to stop inflation. You're not going to stop inflation unless you force a recession because this is sentiment. This is about people being nervous and not spending as much and pulling back on their spending, right? And you're not seeing that yet, where we thought we would see it and we thought it would come down a lot quicker, but just to show how much even CPI, PPI. I mean, CPI, we're still seeing, 6.4% year-over-year prices, right? That's how much inflation is. Mm-hmm. And that's 3x of where Powell said that he wants it, which we thought it would be lower by now. I thought it would continue to be going down a lot lower, a lot faster. That was a big surprise. And we didn't get it like, oh, it's a seasonal. This is 3 reports, bang, bang, bang in a row. Okay. And it's coming across, producer price index, right? So producers, factories, orders, and things like that, and then consumer prices, and then retail sales. I mean, it's 3 categories that came out that just punched in the face 3 times. And, we're seeing it right now where stocks should have took a hit on these and they didn't. And now you're seeing it this week where, all of a sudden everyone went from super bullish to bearish.
They waited till yesterday.
Yeah, in like a day. So I want to move on because there's an interesting note here, Daniel, from Mike Wilson. Mike Wilson's the guy from Morgan Stanley. He is the person that, told everyone that the market was going to crash. And he was been very bearish even in December. He said we could see a market rally, but it caught him off sides as well as a lot of other people off sides. And he put out a note, and it was weird because he put this out on Sunday. The markets closed Monday, so everyone was talking about it yesterday, and I think this helped contribute to the market coming down. We have that note, right? And he said he's comparing the current market to the death zone on Mount Everest. So that's the altitude which oxygen pressure is insufficient to sustain human life for an extended period, right? So he's comparing that, he's using that term, the death zone for the markets. He's referring to the equities or the earnings risk premium, the ERP, okay, which is the excess return from equities over the risk-free rate. So the risk-free rate is, you use 6-month T-bills is over 5%. So if you say in the past, you expect to earn 8% on stocks annually, right? On average, that's usually the percentage goes up pre-COVID. For the past 50 years, on average, around 8%. If the risk-free rate was 2%, so say if 6 months was at 2%, just say, then the equity risk premium is at 6%, which is pretty good. The lower that number goes, the worse it is, right? Meaning you're taking more risk. And it's important that you understand this because I might not be explaining it well, but I'm going to try. On the average since 2008, it's around 4 to 5%, right? Which is pretty good, right? So if you're buying equities, you're assuming 4 or 5% over, something that you would get for free and interest rate that you would get for free. That's what it's usually been. In fact, since 2008, it's hit 3% a few times, which is rare. Right now, it sits at 1.5%. There is nothing on the timeline that shows anything close to this. So let's think about that for a minute. If you're watching this on YouTube, I'm going to bring up a chart. But you could earn 5% risk-free, right? Sleep at night, perfectly fine. But according to models, you're going to earn about 6.5% on equities, right? And you could debate that model back and forth. So is it worth to buy stocks here when you see the massive headwinds where you have higher rates coming, possible recession? Again, these are debatable, possible recession, slower job growth, inflation picking back up now. I mean, does it make sense to own? Think about the staples, right? So you own Pfizer, UPS, Kellogg, Clorox, Broadcom, Exxon, Chevron, Coke, Citi. These are companies that are, staples, not really growing that fast, but they all pay 3% yields. And a lot of people use that and say, wow, I want to earn that 3% yield. Well, why take the risk? Because that 3% yield could be worth nothing if these stocks come down 10%, right? That means you still lost money when you could earn 5% risk-free. And as an equity fund manager looking at this, I feel like at the beginning of the year, they saw this and said, okay, we're off sides, and so much money poured into the market the last month where the NASDAQ was up, 16% in 40 days, which is freaking insane. But right now, you're looking at equities being more expensive, more risky than almost any other time that's on the map. And I'm going to bring this up really quick because I'm showing this, and this is, I was able to get a picture of this. If you guys on YouTube, you could see it. And the death zone, right, it's a high-risk zone is in yellow, and then there's a death zone below it for those of you who are just listening to this on iTunes or whatever. We've been in the high-risk zone, the yellow part, which is between, 2% and 2.7%. A couple of times, and every time I hit that, we were okay. We've never been at these levels. I mean, you could just see we're in an area that's in uncharted territory, meaning that is it really worth it? And those are the big stocks, right? And now when you're seeing rates go higher, it should mean that a lot of the risky stuff is going to get killed even more. And that's not happening. You're seeing a lot of those stocks continue to go higher up to this week. But that report has been surfacing. They mentioned on TV a little bit. And again, this guy has been right, he's been wrong recently. But when you're looking at the details of this, it presents a very scary situation because for the first time ever, Daniel, first time since, pre-2008, where you're looking at so many of these, retirees begging for yield. I mean, this is why the housing market, this is why the housing bubble happened, right? You had all these AAA ratings and all these fake ratings that they put on, they created, these products that offered high interest AAA ratings on it, and then they offered synthetic products, and everybody trillions flooded in to earn an interest rate in a zero interest rate world. Now you can get 5% for free. It makes the investing part into equities, it's not as enticing, and you could see money flow out. And that's the danger of this market right now when you see rates going higher.
The chart, what do they say? A picture's worth 1,000 words. Mm-hmm. That makes total sense. We were talking offline, and I'm a very simple person. I hate formulas, and I was talking to you about these formulas. I was like, these things drive me nuts looking at you can just go into any search engine and look at the equity risk premium. The wild thing to me, it's tough to wrap my head around saying, okay, it's better when the equity risk premium is higher than lower, but it makes sense to say, hey, you're taking on a lot of risk to only generate 1.5% 1.5% over bonds versus, like you said, in the last average is 4 to 5. this just is the picture is amazing to me, and it just shows you, hey, this is a great data point to think of a T-chart. Hey, I'm bullish, I'm bearish. What do I think of the overall market conditions when I go and add positions to my portfolio? That chart to me just screams why you should have exposure to bonds. It's just a simple thing of saying, hey, right now, just keep this in the back of your head. Things are very, very tilted to one side based on historical data. Mm-hmm. Like you've said, doesn't mean tomorrow is going to change everything and be totally different environment. Simply says, hey, the market is giving you 5% annualized, guaranteed, risk-free. Why wouldn't you take that? And I don't think there's a good argument to say that you shouldn't take that for a portion of your money. I think that that's what that chart says, simplicity. And that's why charts are amazing, Frank, because reading through jargon sometimes is like terrible. But you see that chart and it's like, hey, I don't need to know everything about this. This is an extreme. I need to file this away in the whole common sense department.
And we've done this too in our industry where, we have great editors throughout my career. I've had them. And whenever you have a chart, the reason why you have a chart is because it makes it very easy to explain something. And a lot of times people use charts and it's more confusing. This is a chart that's not confusing.
Yeah, exactly.
You can see it. So for any of you out there who want to become publishers or write, you have to convey that message. And if you want a bigger audience, you got to simplify it and you have to make it simple. This chart makes it pretty simple because when you talk about equity risk premium, people are like, what are you talking about? It's just, the lower that number, the worse. We're in uncharted territories to take on that kind of risk and earn that little return, right? Because the whole world is about risk reward. That's what it's about. And that's one of the things I said, and I always highlight my mistakes. One of the things I'm most proud of is being bearish on the market, but being able to outperform in a lot of the newsletters while protecting ourselves. I mean, that's the goal, right? That's what you really want to do, right? If you could do that, if you get off protection and take on less risk, but still generate very strong returns compared to the market, that's the goal. That should always be your goal, 100%. In this, the risk reward, I mean, look at the risks that you have to take, and the reward is very, very little compared to just saying, you know what, I'm just going to throw this in there and just earn 5%. Mm-hmm. So that you need to understand that because sooner or later that matters. And if rates are going to go higher, and I don't know.
Good point. The momentum right now is that's going to go up.
Yeah. I mean, we're seeing rates pull back.
So 5 now, but it might be 5.5 or 6 in 3 months.
Yeah. I mean, we're seeing rates pull back a little bit right now. So, which is good. The 10 years like at 3.91. It was it was almost 4%. I think it was yesterday, the day before, which is crazy. But you're seeing like this back and forth, this pull and tug, and so those are the negatives.
So
right?
Be cautious.
Yeah, so be cautious. But on the positive note, and again, there's no bias here. For me, it's all about the data. It's not like, all right, I have this agenda, and oh my God, this better happen. My job is to be right, and help people make money. ZipRecruiter posted numbers that were absolutely horrible, and I think this is actually a decent sign, right? Because what's the one constant that's been crushing the Fed? It's the job market. The labor market's been so strong. You'd love to see the labor market come down because then you're going to see inflation come down, likely even more. But we're not seeing that, right? So the Fed's like, wow, okay, we're going to keep raising and raising and raising. This is where you're going to see everything come to a head because they're going to raise much, much further than they have to. And ZipRecruiter is, it's down 17% right now. They reported this morning, one of the biggest online employment marketplaces in America. Ooh. Their guidance was horrible. They're seeing next quarter revenues at $180 million compared to $207 million. That's a very big miss. Full year 2023. Okay, they expected $934 million revenues. They loaded to $780 million. Okay, so this is what they said. This is much more important. They said with an increasingly uncertain macro economic backdrop, employers have moderated their hiring plans and reduced their recruitment budgets in the first weeks of this year. The weakness in 2023 is more pronounced among small and medium businesses than among larger enterprises. As a result, January's revenue was down 50% year over year. What they're saying is companies are slowing down their hiring. And you need to see that, right? You really need to see that. That might mean we're going to go into recession. Maybe we don't go into a recession this year because a lot of stuff is coming back and we're seeing, prices start to go higher in some areas, which you're like, holy cow, how could that happen? But it's happening, right? Rentals are starting to go back up a little bit. Look at Toll Brothers with the housing market. Toll Brothers said that very strong earnings. But Toll Brothers, and I think also as a positive, they said the company attributes, the increase in demand to improving buyer sentiment as inflation appears to be receding. And it said it has seen a meaningful uptick in demand that started in January and has continued through this past weekend, which, listen, I know a lot about houses. People could lock in their rate, and they probably locked in their rate. But I got to tell you, someone looking for a house that didn't lock in their rate 3 weeks ago compared to now, that's a big difference.
Yeah.
I mean, you're looking at below 5% to 6.6, 6.7. That's what's saying on the average on the website. I mean, that is a huge difference in your payment. If you're locked in, you're locked in. You're going to buy a house, that's fine, right? Maybe you're locked in when they fell below 5% for a little while. But right now, it's going to be interesting. Like Toll Brothers, to me, seems like it might be actually, I always hesitate to tell you to short a stock, but, you can buy puts on it, maybe short-term puts. But I think they're going to come out, and a lot of these home builders may come out with warnings because I just don't see demand picking up next quarter. They still have the backlog and everything, but
that's the kicker there.
It's going to go forward. Right. So those are two positives, but I'd like to see 6 months from now, again, it's 6 months. They're going to talk about 6 months after that. And that's where you could see, demand fall off a cliff, but I don't know.
Toll is interesting because Toll is worth watching because it's a higher portion of the economy. And I'm not being rude. We're all at different tiers of the economy. And yes, they're having cancellations. I don't know if you have it pulled up. I think they said they were down 20-some%. Am I way off on that?
Is it the cancellations?
Yeah.
Yeah, I'm not too sure.
I could have been wrong on that. My point is that they have billions and billions of dollars of backlog. Yes, they're going to lose some, but those guys are different than your average Joe buying a house in the real estate market. So that's why I think it's key to look at some of your higher end builders, some of your lower end builders, your more starter homes and things like that. No doubt inflation will make its way through each market and have different effects. I wouldn't race to run out and buy Toll here, but I have to tell you, I'm not as bearish. Like I wouldn't touch it right here, but because of the chart and it's, doing very nicely. I just think this continues to impress me, but I think it's a pocket of a higher income threshold. And I think that's something to pay attention to.
Yeah. I'm looking at notes on briefing now to see, but it's funny because they said, the White House, right, announced that, through HUD, right, the Federal Housing Administration, to reduce its annual mortgage insurance premium by 0.3 percentage points. So from 0.85 to 0.55 for most new borrowers. I always look at this as a huge negative. When you're making it easier for people temporarily to buy, they still have to pay their mortgage, right? So it makes it more difficult, especially with the job market, especially higher rates, which is going to result in a lot of your bills getting higher and higher. So I hate when they do this, and this is what happened even during the credit crisis. We're definitely not even there. The banks are much more capitalized now. But just looking how they said migration trends have favored, sunshine mountain states. So we're seeing that as well as Florida, just the demand here. And everyone I talk to in New York is like, I'm going to Florida or Texas or whatever. You just see that. But, overall, the reason why I want to bring in Toll is seeing, just inflation moderate, right? It's the receding, which is good. And then you see ZipRecruiter, which is bad for ZipRecruiter. The stock's getting nailed. But, they're seeing how, due to macroeconomic, that uncertain backdrop, that people are cutting back in terms of hiring, and we really haven't had any evidence of this at all, right? We've seen the layoffs, right? But the numbers that they're reporting are great. This is the first time we're seeing that, like for the full year, they're expecting things to get really bad. That's a good sign for the Fed. That's a good sign that, okay, maybe we don't have to go 50 basis points. Let's see what the data comes out over the next, couple weeks or so. But that's what we need to see, guys. This isn't like we're going to see growth. It's going to be a great market and inflation is going to go down. You can't. You have to force a recession. Okay, that's what happened in the 80s. You have to force a recession. They forced it. They reverse course too quick, and then we fell back in recession. Rates started going higher. Inflation started going higher again. Powell's aware of this. He's not lowering rates is off the table for this year. We're not lowering rates, so that's off the table, which is part of the bullish thesis.
I mean, he literally said that last meeting in this press conference.
Yeah, but people just don't believe it.
I know, it's great. They're
just pricing in and don't believe it. But
that's the old marriage joke about he said, she heard, or vice versa.
Yeah, exactly. So there's some other earnings too, right? That you were covering that interest you, and this is what we're doing. Just right now, a lot of small caps are reporting. Most of the large caps, I think it's 85 to 90% have reported now. But a lot of small caps, mid caps are starting to report, right?
Yeah, I don't know where this fits in right off the top of my head, but going from luxury to how you got to fill that luxury house, would you put in oh, that's a good question for you. Are you getting a Lazy Boy recliner, Frank?
I am.
Nice.
I'm gonna see? We actually went to Lazy Boy. They have great furniture there, and they came out with a good quarter, right, yesterday?
Yeah. Do you have the chart up, LZB? Do you have FinViz or anything, if you would pull it up?
I'll bring it up in a second, yeah.
Yes, they just reported yesterday. They reported they beat by 25 cents. They earned 91 cents a share. Revenue rose 0.2%, so nothing there. But they guided for the fourth quarter. They don't operate on a calendar year, so they didn't report fourth quarter. They reported third quarter earnings. Guidance for the fourth quarter is 525 to 500 million in revenue. That was first 526, so we're all good there. When you pull up their press release, here's what stood out to me. So I like to look at companies like this. If you pull up a longer-term chart, Frank, you're going to see that it's pulled back significantly because of why? Because when COVID and our government...
15% now. It's up 5% to start the market.
Yeah.
930, so 15% now. Look at this.
They got a lot of pull...
52-week high.
Yeah, they got now. It's still down significantly from a year and a half ago. If you back out,
so this is So if we look at a year,
but
closing in, yep.
What's interesting here is that
Good call.
They are, when you think of, hey, they got a lot of pull forward through COVID lockdowns because nobody could go anywhere. Furnitures and all that. We saw that across all kinds of spectrums from our house and everything else. What's interesting is that Chief Financial Officer Bob Lucian, that's probably not correct. He says, we've essentially worked down our backlog to pre-pandemic levels. We anticipate fourth quarter delivery sales will be at levels consistent with what we write, consistent with historically seasonality, and almost 20% above pre-pandemic. That is a heck of a number. Yeah. Because just like you've talked about macro picture, hey, look at earnings before COVID and how they, were peaking before we got all this stimulus. This is one of those sector and areas that you can put on your watch list because they're improving margins, they're improving cash flow, they're paying down debt, they're getting back to pre-pandemic levels, and they're quoting about taking market share and such like this. Mm-hmm. This is one of those pockets. We've talked about Eaton. We've talked about different companies in the past. This doesn't fit with the overall narrative of, hey, we got trouble coming. Doesn't mean it's not. But my point is that there's great companies and great risk reward out here to look at. Hey, these guys' fundamentals are solid. They're still doing. I love anything that's pre-pandemic and getting through inventory it should get your attention. It's not an all clear signal, but that shows you management is doing what it needs to do. And going forward versus the last 10 years, we've talked a lot about this being different. Management matters. Decisions that you make on how to allocate capital, how you do these guys up their marketing, saw great returns from it. That's what you want to see. You don't want to increase marketing spend and not getting results. That's terrible downswirl. That kind of stuff. So I'm really looking for pre-pandemic levels and all this to try to find some, diamonds in the rough, as you would say.
I can tell you my personal experience with them because, we have to get furniture for a new house. So we're looking at different places. And a lot of times you get people all over you, right? They're just all over you. And it's kind of like, all right, leave me alone for a little bit. It's not a fun experience going into a furniture store. I don't think anyone says, oh, I had a great experience. I had a good experience going in. The lady was like, hey, if you need anything, she walked away. She was very funny. She was an old lady. She was very, very funny. And then we had to put down, we were looking at a couch that we liked, a really nice couch. And then I was looking at some of the lazy boy chairs and everything. And she said, look, if you put down, $500, what we do is we'll come to your house and give you, like a free, we'll just take a look at it and free design and everything. And that's what they did. They came to the house. I said, okay, because I know I'm going to at least buy a chair there. Yeah. But the couches they had there were great. You saw the inventory. It wasn't like a ton of stuff on the floor, which is good.
Yeah.
And they said that some things will come, you can get in 3 weeks. Other things might take like 2 months, 3 months.
Oh, okay, they were going to say a lot longer. That's still rough, but that's not still rough, 9.
But yeah, so, but that's, because you get to really build it how you want. You choose the colors that you want. Sometimes other places only come in a couple colors. What I liked is they did come to the house. They did like a whole outline. Now we're going to go back there and they're going to show us like a whole design of all colors of how they could do it. It's just a better service, right? It was like a much better service. Daniel, you and I talked about this. We talked about this like 6 months ago, 3 months ago. The economy, the contrast, right? The separation between companies is going to be incredible where you got used to free money, zero interest rates. Everything was cool where, all the FANG names moved higher. A lot of cloud companies moved higher. Some moved a little bit more than others. But, you could have been wrong on a company and still made money. Right now, it's different, right? Because you're seeing the separation, like you said, in management teams. Where look at Walmart and look at Home Depot, okay? Look at Meta and look at Google with the latest earnings. But Meta got it, right? They're up 40% year to date. They were down much more than Google. Google's only up 4%. But for me, I see, the chat GPT, the AI, I feel like is this pressure on Google, right?
You talking Terminator stuff over there with that?
Yeah, but then with Meta's like, okay, we need to address it. We need to go back to our roots. Yes, we want to focus on the metaverse. That's our growth model, but we want to let's not make it 100% of our company. And then we want to cut costs, and they got it, right? Where Google, I think, still hasn't gotten it. And then Netflix and Disney, big difference over the past 6 to 9 months. And also in autos, right? Look at Stellantis, which is Dodge, Jeep, Fiat. They blew out the numbers today. Very good quarter. GM crushed it, and Ford was absolutely horrible, right? So you're not seeing everything. I mean, you're seeing Ford actually move up when the stock should be down probably 30, 40% from here since they stopped producing one of their top cars and they don't have the battery technology. But you could see the difference. And that difference in this type of market, you need to understand. And you brought up, just a second ago, where management teams matter. When you're in an environment where money's no longer free, when you're seeing higher rates, where you have to cut costs, right? I mean, management teams matter. And it's not about increasing your total addressable market, which you're going to see most total addressable markets shrink. It's a matter as they're shrinking, you're gaining market share, and that's what you're seeing out of Lazy Boy. That's what you're seeing Netflix starting to outperform everybody else now. You're seeing Stellantis and GM, again starting to outperform Ford. Are you going to go and get a Ford F-150 Lightning right now? You'd be crazy to, because they stopped making them right now. They pulled them off the market because of the battery technology and the fact that they were so vague about it and they didn't say what was specifically wrong. Is it something major? Is a car going to blow up? Am I going to die? Or is it something minor that you could fix? And they said, well, we might start producing soon. It's a big difference there where, this is how great management teams in this type of market, you take market share, you put your flag on the ground, you cement it. Hey, we're doing great. We're the industry leader. But this is a time for CEOs to step up, to cut costs, and just, work on their growth markets. Don't get too crazy with marketing and spending. You're cutting back. And you see the difference in stocks, which makes it a stock picker's market. I think it's going to be like this through 23, 24, because conditions are going to be very, very volatile and crazy due to all the headwinds that we're seeing where, again, it's inflation. Are we going to be in a recession this year? If not, does that mean that the Fed is going to continue to raise rates? Do we go to 6? Some people are saying 6.5, 7. Some people threw out 8, which is insane as a terminal rate.
8 would be.
I mean, it's all over the place. It is all over the place, right? The job market's strong. ZipRecruiter, number one, employment company that finds jobs for people, is saying that's going to be terrible. So you have these extremes and these back and forths where there's no clear signals, and that creates uncertainty. In an uncertain market, you have to be very careful, because if it's uncertain, just with the economic data, it's telling you that people are uncertain. And if you're uncertain, you're not going to go out there and you're not going to spend as much as you usually spend because you're nervous. You're worried about the market. Yeah, your portfolio came back a little bit. It's still down. Your home prices come down. You're seeing your net wealth, right, come down, and you're worried a little bit. So with these types of conditions, stock picker market, it matters, right? And this is what Daniel and I are going to be breaking down in Wall Street Unplugged Premium now, where we're going to be breaking down these companies. This is the type of podcast you're going to see with real details. I'm going to be able to pick one stock, have a write-up for you, throw it in Dollar Stock Club. This also gets you access to Frankly Speaking. A lot of it's going to be behind a paywall. And again, if you guys are interested, WallStreetUnpluggedOffer.com. It's $10 a month. And again, you can cancel anytime. I had a subscriber ask, Frank, you're charging for a podcast. Is that going to work? It's having this great content for our most loyal subscribers. And when I look at $120 and the work that you and I did, especially during COVID, and helping people and helping their families, I think that is a necessity to get something from someone that's independent, and someone that doesn't give a shit about what anyone thinks of me. It's about providing the best advice, giving you guys our best research, quality research, Wall Street research to the average Joe, which, you don't really get out there. Right, a lot of places charge huge premiums. This is an affordable product, but it is going to provide a lot of great content to our best subscribers. And Daniel, this is, I don't want to say your last podcast, because you'll probably come on even, sometimes when I'm doing my monologues. I'm going to be doing those on Wednesday, like 5 to 20 minutes. That's going to be the free podcast, Wall Street Unplugged, going forward. But
good.
If people want Daniel, right? If you really like Daniel, if you hate Daniel, you're perfectly fine. You're happy right now, right? You're like, yes, thank God.
Daniel at CurzioResearch.com, yeah.
Yeah, tell us all about it.
It's funny. I like that guy asking you, how's that going to work? Well, ask us in several months. Guy asked me last night. I was out, and he said, hey, how's the whole podcast thing going? I said, we're launching a new one. Ask me in 3, 8, 12 months if I'm still here.
And people are, well, it's a different model for podcasts. For me, it's, people are going to pay for great research. They're going to pay for people that help them, that care about them, which you guys know you do. That's why we have hundreds of thousands of people listen to this. And I know that a lot of people are going to convert over to this, because it is going to be a necessity to them, because we're going to be out there. We're going to be asking the tough questions. We're going to have great interviews, going to be in the field, providing you great ideas, trading ideas and stuff like that. And that's what I'm looking forward to, to really providing that value for the subscribers. So it should be really, really cool. But again, questions, comments on that, feel free to email me, frankcurzioresearch.com. Again, it's WSUoffer.com. If you want to subscribe, it's the only way you can subscribe is by going to that webpage. Daniel, any final thoughts?
Nope. Cheers.
Final thoughts? Nothing at all. No sign-off. No special sign-off.
Wish me a happy birthday. It's tomorrow.
Wow. So someone to send you. So you can't.
You had to pull that out of me, see?
No negative emails, guys. No negative emails. You cannot. You can
send me anything negative.
No.
On your birthday. On your birthday, it's glass overflowing. You can say anything you want tomorrow, and I'm going to ignore the hell out of it.
Just for this week. Can I ask how old you're going to be?
37.
Yeah, you're getting up there.
40.
The difference between 30 and 40 is huge. Everything hurts.
So obviously I'm a glasses wearer, and I was getting my new prescription recently, and the woman that was doing my, I don't know, what do you call it, pre-exam or, whatever. She says, I said, hey, how bad are my eyes going to get over the next couple of years? Like, can you give me an idea how much my prescription will change? And she just grinned and looked at me and says, well, you're going to be 40 soon. They're going to get a lot worse. I said, thanks. At least I like honesty.
Honesty is the best. Honesty is the best. Thanks, Daniel. All right, guys. So questions, comments, again, feel free to email Frank, CurzioResearch.com. That's it for me, and I'll see you guys tomorrow. Take care.